Hello again, and welcome to the third and final part of our Equity Method webcast. I'm Filippo Poli, Technical Staff at IASB, and once again I'm joined by my colleague Mustafa Muit.
Hello everyone. In the first part of our webcast, we introduced the project. In the second part, we looked at the main proposals in the exposure draft. In this webcast, we are going to explore the remaining proposals.
IAS 28 requires an investor to stop recognizing his share of the associate losses when the carrying amount of the investment has been reduced to nil, unless the investor has incurred a constructive or legal obligation. But this is a requirement that sometimes creates application questions, and we have an example on the slide. What happens when the investor has unrecognized losses and purchases an additional ownership interest? Are those unrecognized losses recognized at the moment of the purchase?
The IASB is proposing the investor does not catch up losses as a reduction from the carrying amounts of the additional ownership interest. This proposal reflects the IASB conclusion to view the investments as an accumulation of purchases. However, remember that as long as there are unrecognized losses, an investor is not allowed to resume recognizing profits. Another area for improvement is how the standard describes the impairment indicators. For instance, the IAS 28 still uses old language, such as a reference to a significant or prolonged decline of the fair value of the investment below its cost. Is that right reference? Or should the investor compare the fair value to the carrying amounts at the reporting date?
Well, the IASB is proposing to replace that reference with a reference to the decline of the fair value below the carrying amount of the investment. This and the other proposed changes would align the wording more closely with what we have in IAS 36. But it is important to note that IASB is not proposing changes to how an investor determines the recoverable amount of the investments. So the measurement requirements in IAS 36 still apply. So let's move on to disclosure. Mustafa, could you walk us through how the IASB is proposing to help users understand the facts of the proposals?
Of course. As you can see from the slide, the IASB is proposing some new disclosures into IFRS 12 to provide information about the effects of the proposals. The IASB tried to achieve the right cost-benefit balance. For example, the IASB is proposing to disclose gains or losses from downstream transactions, but not from upstream transactions, because collecting this information from associates would be costly for the investor. Filippo, can you tell our viewers what else regarding disclosures?
Yes, the IASB is also proposing that an investor disclose a reconciliation of the opening balance to the closing balance of the carrying amount of its investments in associate and joint ventures, disclosing items such as the share of the associate profit or loss, the distribution received, or purchases and disposals. This reconciliation will help users to understand the reason for the change in the line item and distinguishes the effect of cash transactions from non-cash transactions.
Thank you, Filippo. I think there are quite a few new requirements. Does the IASB anticipate any complexity in applying the proposals?
Well, the IASB has considered this and is proposing a number of reliefs to facilitate the application of the proposals. So most proposals would be applied prospectively. At the transition date, the investor would be required to recognize the remaining portion of gains or losses from transaction with associates by adjusting retained earnings. The investor would also measure contingent consideration, the fair value, with the corresponding adjustments to the carrying amount of the investments. Entities should have the necessary information available to make those adjustments. Well, in addition to all the proposed requirements, the IASB intends also to improve the understandability of the standard?
Yes, this is part of the outcome of the IASB third agenda consultation. The purpose of that is to support consistent application of the IFRS accounting standards. IAS 28 was first issued in 1989, and over time, new requirements have been added or existing requirements were amended on a piecemeal basis. The exposure draft reorders the requirements by topic to align with the most recent IFRS accounting standards. The exposure draft includes a table of concordance, and we are also making available a markup version of the exposure draft that shows how the requirements have been grouped and reordered.
And with that, we have come to the end of our three-part webcast series on our exposure draft on the equity method. We hope we have given you a good understanding on the proposed changes. We'd like to thank you for joining us throughout this series.
To find out more about the project or submit comments on our consultation, please visit the IFRS Foundation's webpage. Remember that the comment period is open until the 20th of January 2025. We look forward to your feedback. Thank you.